If you've been sitting on the sideline saying, I need to make more money before I can buy, this video is going to change the way you think about that. Because here's the truth, salary is just one piece of the puzzle. And honestly, it's not even the most important one. I'm Brian Scott Cohen, your mortgage guy, and in the next few minutes, I'm going to break down exactly what lenders actually look at when they decide what you can afford. This is the stuff nobody tells you until you're already sitting in front of a loan officer. Stay with me. This could be the reason you end up buying sooner than you think. Let me paint you a picture. You're making $85,000 a year. You Google how much house can I afford, and every calculator spits out some number that feels totally out of reach in New York City. So you think, I'll just wait until I get that raise, or I need to be making six figures before this even makes sense. Sound familiar? I hear this every single week. But here's the problem with that thinking. Those calculators are only looking at your income. Lenders look at an entirely different picture. The metric that actually drives your buying power is called your debt to income ratio, your DTI. And once you understand this number, the whole game changes. DTI is a simple formula. Take all your monthly debt payments, car loans, student loans, credit cards, the new mortgage, and divide that by your gross monthly income. Most conventional loans want to see a DTI below 43 to 45%. FHA can go a little higher. Jumbo loans tend to be stricter. Here's where it gets interesting, and I want you to really hear this. Person A makes $100,000 a year, but they have a $600 car payment, $400 in student loans, and $300 in credit card minimums. That's $1,300 a month in debt before the mortgage even enters the picture. Person B makes $80,000 a year, no car payment, paid off their student loans, minimal credit card debt, maybe $200 a month total. Who do you think qualifies for a bigger mortgage? Person B, the one making less money, wins in this scenario. Your salary sets the ceiling. Your debt determines how close you could get to it. So if salary isn't the whole story, what moves the needle on what you can afford? 3 levers, let's break them down. Lever 1, your debt load. This could be the fastest thing you can change. If you're carrying a car lease or credit card balances, paying those down even partially could dramatically improve your DTI and expand what you qualify for. I've seen clients increase their buying power by as much as $50,000 just by eliminating one car payment. Lever 2, your credit score. Your score doesn't just determine if you get approved, it determines your interest rate. The difference between a 680 and a 760 score on a $700,000 mortgage in New York could mean hundreds of dollars a month in your pocket. Hundreds, every month, for 30 years. Lever 3, your down payment. A larger down payment reduces your loan amount, which lowers the monthly payment, which lowers your DTI. It also eliminates PMI, private mortgage insurance, which could add another $200 to $400 a month on top of your payment if your down payment is under 20%. Salary is fixed, at least in the short term. These 3 levers, you can actually control them. Now, let me get NYC specific for a second, because buying here is a different animal. In New York City, co-ops, which make up a huge percentage of the available inventory, have their own underwriting requirements on top of the lenders. Some co-op boards require post-closing liquidity. Some have their own DTI thresholds. So you might qualify with me on paper and still need to do some prep work to satisfy the building. This is exactly why working with a mortgage officer who knows this market isn't optional. It could be the difference between getting into contract and getting declined by the board 6 weeks later. The good news, if you're working with the right team, and I may be a little biased here, we could reverse engineer all of this for you up front. We look at your full financial picture, we run the numbers, and we tell you exactly where you stand and what moves to make before you ever start shopping. No surprises, no wasted time, no heartbreak over a place you could have had. Here's what I want you to do right now. Before you open another listing, before you go to another open house, pull out a piece of paper or open your notes on your phone and write down 3 numbers, your gross monthly income, your total monthly debt payments, and your credit score. Then divide the debt by the income. That number is your current DTI, and now you know exactly what we'd be working with. If you want me to run through your actual numbers, no strings attached, there's a link in the description. We'll do a full buying power analysis, talk through your timeline, and give you a clear picture of where you stand today and what it would take to get you to the finish line. I'm Brian Scott Cohen, your mortgage guy. Subscribe for a new video every week where I break down everything you need to know about mortgages. If this helps, subscribe to my channel and drop your questions in the comments. I read every single one. See you next week.